Blockchain Show is a podcast that demystifies cryptocurrencies and distributed ledger technology.
Hello, everybody. Welcome back to the Blockchain Show. Today, we're going to dive a little bit further into the realm of decentralized finance. Today, my guest is Evan Kuo, the co-founder of Ampleforth, a decentralized commodity money like Bitcoin, but with near-perfect supply elasticity like fiat. Evan, welcome to the Blockchain Show.
Thanks, Ethan. I'm glad to be here and really grateful for the opportunity to kind of talk about what we're up to.
Yeah, man, this is going to be good. Maybe the best way to get started is just to have you introduce yourself a little bit more to our audience since it's the first time on the show, and we'll kind of just get into the blockchain stuff soon after that.
Cool. So as Ethan mentioned, my name is Evan Kuo. I'm the co-founder of Ampleforth. I originally went to school at UC Berkeley and studied a mix of mechanical engineering and computer science before eventually linking up with my co-founder, Brandon, who is, former Google search engineer and then Uber engineer, but largely a computer scientist. And then we kind of designed this new money that I think will be very interesting for us to talk about here.
Is it decentralized finance?
Yeah, it is decentralized finance. So, decentralized finance is kind of this movement to create a parallel financial ecosystem beyond the reach of politics. And it's starting to gain traction. Last I checked, there's about $1 billion in assets locked into it. And a lot of what's being done is the creation of kind of, I guess, what I would call decentralized banks that string together these assets using smart contracts to produce new types of synthetic assets like equities and to create like lending instruments or credit instruments, or just even stable currencies through a decentralized banking system.
Yeah, this is a term I've really only heard pop up on the show the last couple of months. I know it's been around a little bit longer, but it sounds like you're kind of like in the right place at the right time. I mean Berkeley, it's a really cool spot to be. How many years ago did you realize that you wanted to get into the kind of the blockchain side of things in the tech world?
Wow. Quite a long time ago. I guess you can start a little bit about, the first time I heard about Bitcoin was shortly after, Obama was inaugurated. It was really, really very much in the beginning. And I had this coworker, I was working at a startup. His name was Ryan, and he was like just a hardcore libertarian. And he had read the Bitcoin white paper and was really into it. And so he shared it with me. He wanted to do some mining, and I started to read it as well. The thing that stuck with me was that, number one, this is a really, really inefficient technical system. It seemed as though it would simply just get slower over time and be harder and harder to maintain. Its designers had made massive trade-offs, right? And I was kind of grappling with like why they might do something like that. And then the other thing that stuck with me was that it seemed to be the case that they were trying to create scarcity in a purely digital context, which was interesting because, digital scarcity is kind of a big deal. It's the reason why people don't bring like camera phones to bachelor parties or bachelorette parties, because you snap a photo and it can be replicated infinite times and nobody needs photos of themselves doing tequila shots on the internet, right? So like scarcity is kind of a big deal. And I remember thinking that was kind of cool. And then forgot about it for a long time, but that stuck with me. Then I guess Ethereum came out, and that was a programmable platform. We started to analyze it a little bit more carefully. There was a period of time where Brandon and I would just get together and read white papers and try to kind of understand what the real opportunity was here. And as I kind of thought about it a little bit more, it got increasingly interesting. When I was really young, I lost my dad, and that does something to you when you're a kid. It kind of makes you think on a slightly longer time scale. So you understand your own mortality. And I guess in my case, I really wished there was more of an information footprint left behind. And so as a result, I've kind of always wanted to just build something that could live beyond me, that could live forever or as long as possible. As I was talking to Brandon a lot in the early days, he kind of had that similar mentality. He had gone through just heroic efforts as an engineer at like Google and Uber to kind of scale ridiculously complex systems. And similarly came to this conclusion that every line of code that he had ever written would soon be replaced. And also sought to build something that could live beyond him. And Bitcoin had that quality, kind of reminded us of a natural commodity or natural resource like gold. That's kind of a really impressive thing, right? Because, banks come and go, people come and go, companies come and go, but like kind of gold and other natural resources tend to last a little bit longer. So there was that appeal that like you could create something, some immutable code, so to speak, or encode some sort of, system of values into this distributed ledger that could really last a long time. And so, given that we had concluded that Bitcoin succeeded in creating scarcity in a purely digital context, the Ethereum platform seemed to be an invitation to wonder how we might redesign scarcity. Like what questions remained? What had already been explored? What would the limitations of natural commodity monies like gold and silver today? And what would it mean more to create a money that was better than gold or could do more, right? Something much more like a natural resource, much less like a bank. And so, you can kind of think of this whole movement as, coming from two different perspectives. Either you're trying to increase or expand the role of money because money is very simple, or you're trying to reduce the role of banks, which are very complicated. And so in the beginning, the time of Bitcoin's launch, obviously we were about to enter this, financial crisis, and there was a lot of frustration around the banking system and all its inefficiencies and inequalities. And I really think that Bitcoin was an attempt to create a system outside of banks. That's really how we started, just this epic journey of asking endless questions about like, what have we tried? What have we not tried? And what needs to be built? And we knew that gold had been tried. We knew there was a gold standard. We knew there was Bretton Woods. So that's kind of a deflationary currency. And Bitcoin succeeded in creating almost a digital gold. But what else was there? What had we not tried? Right. And that was the beginning of that exploration.
Yeah, that's very, very well said. I'm sorry for your loss. It's
no, it was a long time ago. Yeah, thank you though.
Like you said, it changed your perspective on time frame and mortality, and I think that sometimes we kind of forget our humanity in this whole ecosystem. I remember Steve Jobs had a quote about all of his technology from years past just kind of it
ends up in a landfill.
Yeah, and it's like a conglomerate of you don't really see the old technology anymore, but it was so important to get to where we are now.
Yeah. There are really precious few things that can live on. And I've always thought of like Newton, for example, Newton's laws. That's the piece of information that tends to get more and more important over time, right? Or other kind of mathematical discoveries or even discoveries in the arts and stuff. They tend to get more and more valuable over time. Whereas, a lot of technologies tend to get less and less valuable over time. They rapidly iterate and evolve really quickly, but any one piece of it starts to kind of degrade really quickly. But Bitcoin was different, and that was really compelling to both of us.
What do you think about Bitcoin nowadays? It kind of lives on in so many different fragmented forms, but some people think it was like a failed experiment. Some people still think it's the one true crypto. What are your thoughts on where we're at now?
I kind of try to think of it. I try to minimize my assumptions, and this is what I've been encouraged by my academic advisors to do as well. And I think what we could describe Bitcoin as today is this kind of speculative asset that has fixed supply, and whose risk and reward profile is uncorrelated with traditional assets. So even if it doesn't become this replacement for the dollar in day-to-day transactions, which I find unlikely. It really has a place in the broader macroeconomy just simply as an uncorrelated asset because people are really looking for risk reduction by diversification. They've been doing that relentlessly since 1953, right? So it's very rare to also have an asset that moves very differently from traditional assets because we're in this kind of global macroeconomy where everything's very connected. The US is the world's consumer and China is the world's producer, and everything kind of is revolving around that relationship, like whether it's equities or real estate or interest rates, cost of human capital, etc. They're all pushed around by these macro forces, but Bitcoin lives outside that system. It doesn't really trade on the same kind of fundamentals as these other assets. It largely trades on like momentum, right, and proxies for media attention. But that gives rise to a unique, uncorrelated movement pattern that allows it to create optionality in this kind of macro system. So that's the kind of the assumption minimized kind of narrative. So I see a very bright future for Bitcoin simply as a digital gold, just as this kind of, uncorrelated asset that might one day evolve into kind of a safe haven asset, but is largely unstable. Now, another potential outcome for Bitcoin is if banks start to collateralize with it or hold it in reserve, then it could become slightly more, not unlike what we had under Bretton Woods, though there are clear limitations to what can be done with a fixed supply asset as a reserve currency. And I think the least likely outcome is that it'll start to be used for, denominating price or paying day-to-day spending, at least beyond situations of absolute necessity where there's simply no other alternative. And by the way, if that's the situation, say you're unbanked and you have suddenly you need some media of exchange that's digital, you'll probably accept any number of solutions that fit the bill. So it's not uniquely designed for that. Or short of like situations where you're really trying to evade kind of authorities and taking advantage of the anti-censorship features of Bitcoin. I don't see it becoming a dominant media of exchange, but just to be clear, I think that the opportunity for a purely uncorrelated, digital gold-like asset is enormous. And Bitcoin is liquid. It's survived against kind of the instincts of many economists. So I am happy with Bitcoin. I'm impressed by it. I think, Isaac Newton, again, who was famously obsessed with alchemy, would have been impressed by this creation of digital gold. On the other hand, he wouldn't have been nearly as impressed by the creation of a bank, right? That's like very humanly, and it's something that the Medicis would be, would pat you on the back for. But to get the thumbs up from Isaac Newton, you'd have to create a digital gold, something much more like a natural resource.
Yeah, I love that. Sometimes I think about, if Bill and Ted's adventure were to happen and Isaac Newton were to come to our time now, would he be, first of all, splitting hairs because there's a certain amount of people that believe the earth is flat again. And what would he think of just where we're at? And it's funny, just speaking of hairs, I remember hearing something that somebody analyzed his hair and he had a significant amount of mercury from his alchemy works. And no one really talks about that very much, as he was really into alchemy, which is kind of cool.
He had reams and volumes of work with it that was never published, probably because he thought people would think he's crazy. But obviously, just a monumental figure.
Yeah. We're seeing more regulation in the cryptocurrency world. We're starting to see the IRS is having questions on this year's tax returns, whether or not you had cryptocurrency, capital gains, that sort of thing. I'm kind of hopeful that that'll help with more adoption, but sometimes I wonder if the Satoshi white paper, how far are we from his vision? Is this going to become a centralized kind of thing? But then I hear about companies like yours that are making an alternative. So maybe you could just break down a little bit, just to transition from the history of Bitcoin and all that, how you guys decided to found Ampleforth and maybe just kind of tell us a little bit about the company, basically.
Yeah, sure. I mean, so kind of like you mentioned, there's this new decentralized finance ecosystem being created. And again, this is like a parallel financial ecosystem that's intended to be outside the reach of politics, right? That's why it's interesting for it to be decentralized. So imagine a banking system that was decentralized, that couldn't easily be controlled by any single government, that just kind of is owned by the people and exists kind of online. We are kind of this new building block or primitive building block for this decentralized finance ecosystem. And I'll get into that a little bit more. So I think really the primitives today of this new DeFi ecosystem are Bitcoin and Ethereum. They're monetary assets really that can be rearranged to create new instruments for lending, for credit. They can create kind of synthetic equities, and they can create banks, right? So now, one of the problems with that is there's this problem in the space where we see a lot of hypercorrelation. So with Bitcoin, Ethereum, and the myriad currencies that have followed it, all of these assets tend to move up and down in lockstep with really supernatural correlations, which means it's very difficult to reduce volatility, right? So they're inherently volatile, but they're all volatile in exactly the same way. So you can't reduce volatility by diversification. I can't simply hold a basket of these cryptocurrencies and have this portfolio of assets that are in aggregate less volatile than any one given asset. And as a result, it's difficult to create a fault tolerant banking system because there's this time component, right? So if I'm going to take out a loan, or if I'm going to, if I'm going to borrow money or lend money, that's usually something that's going to happen for some period of time. And if you're going to put up collateral and the collateral itself is moving up and down really aggressively, it's hard to build interesting systems that way, right? And so that's kind of one of the issues that we're solving, because the Ample is this token that moves differently from other cryptocurrencies and therefore has the potential to be much less correlated. And so it can be used to reduce risk in collateral. So let me just step back for a second and say there are decentralized banking systems like MakerDAO, right? And their goal is to produce a unit stable currency called DAI. And the way they do that is by collateralizing it. So, but rather than collateralizing one for one, like Bitcoin for DAI or Ethereum for DAI, they have to over collateralize. So they began by collateralizing Ethereum, but rather than putting in $1 for Ethereum for every dollar of DAI that could be created, they kind of require that you collateralize greater than that amount, right? And in many cases, people are over collateralizing extremely, like 200-300%. In the case of some of these synthetic equity platforms, like 700%, right? So 7 times the amount you aim to represent is what you have to deposit in as collateral. That's a very inefficient system. And that's because these assets are inherently volatile. And one kind of promising attempt to move away from that in the case of MakerDAO is the introduction of this concept of multi-collateral DAI, right? Where you can collateralize using many different types of assets, not just ETH. But therein lies the problem. All of the other assets are hypercorrelated with ETH. And as a result, adding more assets to this collateral basket doesn't actually reduce risk. It actually increases kind of the volatility of the portfolio. So now they're being increasingly pressured to introduce centralized collateral, like Digix Gold, which is literally the representation of physical gold with a token. So there's probably a warehouse somewhere with a camera and bars of gold, and those bars of gold are represented on a distributed ledger, but it's inherently centralized, right? It's in a physical location. It's regulated, and as a result, it something like that starts to become a systemic risk, because the idea is to build a decentralized financial ecosystem, not just a centralized financial ecosystem, which we already have. Really, this problem could be solved if it was the case that the existing decentralized assets were not so hypercorrelated. So the Ample is very special in that it moves differently from existing cryptocurrencies. And I can talk about that slightly more mechanically. So the interesting thing about the Ample is it has a price target. So the unit price of the Ample is targeted to the purchasing power of $1.2019 US dollar. It receives price exchange information from oracles. And if the price exchange rate of Amples is greater than 1 USD 2019, it proportionally increases the number of Amples everybody has in their individual wallets, right? And if the price exchange rate of Amples to the dollar is less than 1, it proportionally contracts or takes Amples away from every single wallet. So it's very unusual in the sense that normally, you have a wallet and you have a certain number of units in it. The number of units doesn't change. Maybe the price per unit can change. Like I've got 1 Bitcoin, it might be worth $100 today or $1,000 tomorrow, but I still got 1 Bitcoin. In the case of the Ample, the actual quantity of units in your wallet increases or decreases such that the purchasing power or the price of 1 Ample is equal to the purchasing power of 1 2019 US dollar. And this has an interesting effect. So it's naturally counter-cyclical in that when demand is high, it increases supply, and when demand is low, it reduces supply. But it also introduces a fundamentally different set of incentives, because your gains and losses in this system are reflected not just by changes in price, but changes in the quantity of units that you hold. And as a result, right, the profit maximizing actors responding to these new incentives generate a step function like movement pattern. that is expected to be much less correlated with today's digital assets. So you can kind of imagine it as just introducing a different signal. I saw that you have background in music, right? So imagine like all these analog signals, right, moving in lockstep. And all of a sudden you're introducing this kind of step function like signal. I wouldn't call it like digital because it is, continuous, but it has a different form altogether. And for this reason, it will be, less correlated in the long run, and is already less correlated in the short run than the other decentralized assets, which makes it useful for risk reduction by diversification, which is really important as we think about creating these like banking systems that are completely decentralized. So, when you're creating a lending platform and stuff, like ideally you want to borrow money that's stable or lend money that's stable. MakerDAO is this decentralized bank that has manufactured this stable derivative called DAI by collateralizing decentralized assets. And again, it's now being forced to collateralize centralized assets because all of the decentralized assets are so hypercorrelated that you can't really kind of diversify that volatility or risk away. And now we're introducing a new money that, is just going to move differently than Bitcoin and ETH. And as a result, it can kind of start to offset some of that volatility. Now, it's certainly not a bank because we don't have a balance sheet. Right? When we increase the supply of amples or decrease the supply of amples, we do so by adjusting this coefficient of expansion, kind of like, thermal expansion in mercury. Imagine like mercury is in a cylinder. It's connected to a hot body. It expands, right? If you remove it from connection with that hot body, it'll contract. And if you evenly delimit lines on this cylinder, that's how you get temperature. It's the measurement of thermal expansion. So we've got this kind of new metal, right, that expands and contracts not in response to nearby kinetic energy, but in response to price exchange rate, which it turns out is actually, the thing that would have made gold a much better reserve currency under the Bretton Woods system. And I'm happy to talk about that later, but I just kind of want to pause real quick and see if, everything that I said adds up for you.
Yeah, absolutely, man. I really enjoy hearing you speak on the topic. I mean, sometimes as humans, we kind of like to think that things are fixed, but a couple feet from where I'm standing, the temperature is different from where I am. So everything is always changing.
It's meant to fit in any sort of kind of situation, right? Because it seeks a price supply equilibrium, right? It wants like the quantity of units to be in equilibrium with price such that each unit is worth $1. And as a result, it's naturally counter-cyclical, meaning it moves against, supply and demand. But yeah, I mean, the cool thing about it is it'll have like a completely different movement pattern. And as a result, it'll be less correlated with today's decentralized assets. And it becomes this new building block, a primitive puzzle piece with which the engineers that are developing this decentralized finance ecosystem can build more robust instruments.
I like that. And it seems like it's got, I can tell that you have the long view there, which is actually quite refreshing because a lot of the past couple of years, everything has been all about like hype and, token generation and this.
Yeah. For a long time, it really benefited people to just move fast and not get stuck thinking or doing too much research because the market was so hot. And now we've had this winter, so to speak, where, a lot of the people that were in it for the fast money have left, and folks like us who were really curious about the history of money and what could be done, what required a blockchain, what was unique, have the time to breathe and the space to breathe.
Yeah, I often spend time just thinking, what is money on this show? And we've talked about it several times, different cultures throughout the world. And sometimes I wonder in the future if they're going to look back at this time period and if it's going to be revolutionary or just kind of like when people switched from, shells to gold to currency. You know what I mean?
Yeah, totally. And I've actually thought a lot about that because one of our advisors is this guy, Neil Ferguson, who's one of the foremost experts on, he's like one of the foremost financial historians. And he wrote this great book called Descent of Money that talks about a lot of this stuff. But I think, it would be remembered as revolutionary, even if it is an innovation that's kind of layered on top of an existing trajectory, so to speak. So, for a long time, we used these natural commodity monies like gold and silver because they were difficult to counterfeit, right? And they were naturally scarce. But, at some point, after the Industrial Revolution, it became possible to create paper monies that were both expensive to counterfeit and cheap to produce, right? So now we could start to control the supply of money. But that was kind of a technical innovation layered on top of an economic trajectory. We had this kind of problem with, creating money. Even the concept of multiple denominations was complicated, right? So right now we have bills that say 100 and bills that say 1, right, on the same piece of paper. That was difficult or impossible in the case of just things like gold, where like 100 times the volume of gold is just inherently more burdensome to deal with, right, than a bill that has 2 more zeros at the end of it. But even still, for a long time, these paper monies were redeemable for gold. And this is kind of the basis for our original design. So, I mean, right now, again, it's a new decentralized primitive that can serve as a base money for the new DeFi ecosystem. But originally the inspiration behind it was we looked at Bretton Woods and we looked at, gold as a base money. And we asked, like, what would it take to design a money that would have succeeded at the end of Bretton Woods? So, and I'll just get into that really quick. Not long ago, right, dollars were redeemable for gold by foreign governments and central banks under the Bretton Woods system. This was great because it eliminated all risk of things like hyperinflation. And it was very simple. The dollar was kind of used, as it is now, as a global reserve currency. But we entered into this situation where there was, too much dollar demand, right? So the demand for US dollars outstripped our ability to obtain the gold necessary to kind of back those dollars. And what happened as a result of that is the price of gold started to soar, right? Because people they became aware of the fact that there wasn't enough gold. So they were going to hold their gold because, like, maybe a nugget could buy a refrigerator today, but 2 refrigerators tomorrow. You're kind of speculating now, right? And of course, that speculative nature causes people to withhold their gold, right? Which further reinforces this cycle, right? Because, like, now there's even less liquidity of gold, causing the price of gold to soar more. And meanwhile, you have this entire economy that's dependent on the liquidity of gold. So we were really at risk of entering a deflationary spiral under the Nixon administration. And so, what really needed to happen was the state needed the flexibility to increase the money supply counter-cyclically. So, to stimulate the circulation of money, the money supply needed to move against the blind forces of nature, right? So the market was telling everybody to hold because the value of gold was increasing or the price of gold was increasing, but the state needed more money, right? And it couldn't produce more money because it needed to back its dollars with gold. So it's kind of this funny story, right? Nixon at that time was being told by his, advisors that he needed to cancel gold redeemability. And he was like, I'll just do it tomorrow, right? Everybody's watching this show called Bonanza, which was really popular at the time. They were like, no, Mr. President, you need to make the announcement tonight or there will be a run on gold. So it was definitely one of those moments. It was kind of like we interrupt the scheduled programming for an important message from the United States president. And then he delivers his cancellation address. And thereafter, the value of fiat money is entirely at the discretion of policymakers, rather than backed by the scarcity of a natural resource like gold. And I guess the lesson here is that that fixed supply asset can only take you so far when it's being used in support of a real economy. It can't really react to demand enough to fulfill all needs. So it's a well-diagnosed problem, right? So gold is already actually naturally counter-cyclical in the sense that, if the value of gold is really high, then people will deploy more, mining resources to uncovering more gold. The marginal cost of mining gold becomes lower and market forces will naturally increase the supply of gold. And, if the value of gold is low and there's not much demand for it, then, the marginal cost of mining more gold appears more expensive. And so people will dial back their production rates. So it's naturally counter-cyclical, but within a very, very narrow band, right? So it can't profoundly increase its supply in response to demand or profoundly decrease its supply in response to demand. So it's just not sufficiently elastic. And that's where we kind of got this idea where it's like, okay, well, if that's the only problem with gold, then why don't we just make a counter-cyclical commodity money like gold that's perfectly elastic? And that's how we ended up with Amples. And then later we discovered that this was actually going to cause the asset to move very differently in the marketplace. But I guess kind of following that fallout, right, there was this kind of, assessment of where we were. So we used to be in this simple rules-based system where, either you had the gold to back your dollars or you didn't, right? And now we entered into this discretionary phase, which is very complicated. It's like, well, we can now print as much money as we want. It doesn't cost us any more to print $1,000 bill than it does to cost like print a $1 bill, right? Now, so it's entirely up to the policymakers to kind of determine the value of this money, but they have the flexibility to kind of, execute counter-cyclical strategies, which can be really useful when you're in a jam, like when there's an economic shock, like let's say the financial crisis, you want to kind of increase the supply of money to stimulate output so that the whole system doesn't shut down. And so that flexibility is necessary, but it's so discretionary. And so again, eventually this kind of phenomena, this dichotomy really between like rules, like absolute rules and human discretion would occupy the minds of, macroeconomists. And in particular, these two guys, Kydland and Prescott, eventually would win a Nobel Prize in 2004 for their discovery. And what they really did was they kind of, re-articulated this problem of rules versus discretion as like, time consistent versus time inconsistent. So a rules-based system is time consistent, meaning this is a hard and fast rule. It never changes. And a discretion-based system is time inconsistent, meaning, there's rules now, but those change over time as, the economy demands it. But they actually, concluded that economic policies made at the discretion of people, however aligned these people are in their social objectives, would never result in the objectives being maximized. And this is because discretionary economic planning is not a game played against nature. It's a game played against profit maximizing economic agents. So the agent's knowledge of fallible humans behind the curtain, as it were, would inevitably distort incentives to encourage the abuse of any discretionary system, right? So it's like, if I know that mommy and daddy are going to bail me out or going to change the system to support any number of needs, then there's actually another game. It's not like I'm playing tennis against the wall. I'm playing tennis against a person, right? And there are calculated risks I can take that benefit me at the expense of the system. But, as a profit maximizing actor, I have to make those moves. And that's why the equilibrium is never maximized, because like in a discretionary system, your competition isn't nature anymore, like how much gold exists in the world. It's more like, okay, what is the government willing to do? That's the new game that's being played. And this discovery kind of, again, it's a Nobel Prize winning discovery. It kind of left a lot of people in the world of economics kind of missing the simpler halcyon days of commodity reserve currencies that were immutable, right? They're free from human governance. We can't will there to be more gold or less gold. But again, with the memory of Bretton Woods still so fresh, they were all too aware of the cost to go back to such a system. So our question, really was to ask like, well, I mean, given that we can now articulate and design scarcity with algorithms, right? Could a new and different base money alternative to gold or whatever be designed to fit the bill? Like, what would it have taken to create an asset that could have, solved that Bretton Woods problem, but still, be rules based and, much more like a natural resource? And that's how we ended up with the design for the Ample. So, I mean, today with these decentralized banks, there's this problem of hypercorrelation and overcollateralization. And again, just to not overuse jargon, it's the fact that like the phenomena that all the assets move up and down the same way, right? Making it impossible to kind of reduce risk by diversification, by holding a basket, and forcing these systems to like commit considerably more money to the system to produce one unit of whatever they're trying to represent, whether they're trying to represent a dollar or whether they're trying to represent a share of Apple stock. You have to put much more than the value of the dollar in to represent it, or much more than the value of the Apple stock in to represent it, in order to deal with the risk of just the inherent volatility of the system. But yeah, later on, the problem will be kind of more similar to the Bretton Woods problem of like liquidity, right? So, imagine if, DAI, this dollar coin, were to get bigger than Ethereum, would it have to collateralize all of the ETH in the world just to represent its dollar coins, or would it start to collateralize more and more of these decentralized assets? Or would it be forced to collateralize centralized assets? Like, there's this concept in economics of base monies, and at some level of depth, all the banks hold in reserve this type of base money, and that's never collateralized. It's the base money. Like gold wasn't collateralized by anything, just as paper dollars aren't collateralized by anything. So it's some level of depth. It kind of comes down to something like that, that's not a bank, and that's actually just a money. And we're a new money. Yeah, I guess that's the story.
Yeah, that's awesome, man. I really enjoy listening to you speak. You're on like a high vibration. It's really good.
Cool.
You're talking about elasticity and how traditional financial systems, someone has to pump in more of the currency to get the same effect.
Mm-hmm.
With Ample, with the nature of it changing, and trying to understand how this would compare to other cryptocurrencies. So if anybody listening, because we've had other guests on the show who would talk about, burning tokens to kind of,
yeah.
Is there any similarity to that, or is it a completely different way to go?
Yeah, yes and no. So I would say it's similar in the sense that the supply of tokens increases or decreases. It's different in that the manner in which it increases and decreases is completely automatic. It's rules based as opposed to at the discretion of human beings. If a token project says like, oh, there's just too many coins, we need to burn a bunch of them, right? So we're just going to hit delete on all these coins. There's a man behind the curtain there, or a woman behind the curtain there, making that decision and executing the action. With the Ample, its supply policy is entirely determined by a set of rules. And again, it's a simple set of rules, right? So if the price exchange rate of the Ample is greater than 1, we increase the supply of, or the quantity of tokens in everybody's wallet proportionally, right? In a non-dilutive way, right? Meaning like if you have 1% of the network today and it's a $10 million network and, it grows to a $100 million network, you'll still have 1%. You'll just have 10 times the number of units, right? Completely non-dilutive. So it'll increase automatically or decrease automatically. And it makes these supply adjustments by modifying once daily this global coefficient of expansion. Kind of like if you were to modify the gravitational constant, right? Like all the planets just get closer together or farther apart just by adjusting this one number. It's not as though you're like towing these planets like together with chains or pushing them apart, right? By shooting rockets at them or something. It's not a bank in that we don't buy back tokens and then burn them and have this balance sheet or it mint new tokens and then airdrop them to you through transactions. It's really being modified by the adjustment automatically of this scalar coefficient of expansion that happens based on a set of rules. It's kind of the only purpose of the protocol to maintain that supply elasticity such that it can just react to changes in demand. And yeah, it's perfectly elastic and it's counter cyclical. So I've said that a couple times, but like what we mean is like, if there's too much demand, it solves that problem of hoarding, right? So because if there's too much demand and you think the Ample today is going to be worth more per unit tomorrow, we're constantly increasing the supply of Amples that everybody has. And eventually somebody will be pressured to kind of sell. And that introduces liquidity into the ecosystem. That's one of the properties that gold doesn't have, right? So the reason we were at risk of entering a deflationary spiral is because the value of gold started to appreciate really quickly, and that encouraged people to withhold gold. And there was nothing to nudge people into introducing more gold. We saw that as a potential deflationary spiral because the incentive mechanism was just going to tell people to keep hoarding it. And as a result, all the liquidity of the dollar banking system was going to shut down. And this is a currency that was supporting not just a domestic economy, but a global economy. So that's a really kind of unfortunate thing about gold and therefore Bitcoin. If it's used as a reserve currency in support of a functional economy, we'll eventually run into a problem like that. But yeah, the Ample is designed to not have that problem. And again, it's a move towards just kind of expanding the role of these simple commodity monies as opposed to an effort to kind of reconstructing a new bank. We've kind of left that to, I guess other kind of innovators in the space to design the new bank. We felt it was appropriate from our perspective just to expand the role of money, which takes a little bit of the load off of decentralizing a bank because that's a very, very complex endeavor. Banks are just complicated and people don't even know what the problem of banks are. Like from my perspective, it's like, at least we know what the problem of gold is. Let's see if we can design a slightly better money that would just kind of take the edge off of the banking system a little bit.
Yeah, you talk about Bitcoin and Ethereum being the primitive building blocks. I think of the traditional banking system as like just archaic. I've had to deal with them a little bit lately because I have one client that pays me in checks, and I kind of finally had to break down and open a checking account for the first time in like years. And I couldn't believe how just silly the whole process is, man. And it's almost like playing a game. You do this and you do this, and then we won't charge you a monthly fee. And it's like, come on, like there's got to be something better.
Oh yeah.
How do you see this ushering in a new era for everyday people who are just kind of like me, just getting paid in all different sorts of manners still?
I mean, I definitely think that the user experience of banking in the United States isn't the best, right? It's a little bit behind. Like you said, there are all sorts of frictions to creating a checking account. But it's not like prohibitively bad. You'll still be able to get it done. And there are other kind of countries in which this is a lot easier. I mean, even in China, for example, everything is done through WeChat Pay, right? So I can't even get a cab in China without using WeChat, right? So there is this kind of digital payments network, really, as it were, or layer over it that's much more seamless. And so from a user experience perspective, I think a lot of those frictions can be eliminated without a blockchain at all. But I do think the value of the blockchain is, that's decentralized, right? And so we have to ask ourselves, what's the value of creating a decentralized money? Well, it's censorship resistant. And the more pragmatic kind of view on this, as I said today, is it's an investable asset that's uncorrelated with traditional assets. So, I mean, I do think that if we're starting to transact day to day using blockchain currencies, most likely there'll be some sort of layer on top of the core monies themselves that simplify this. And those could be centralized and regulated, likely will be, or they could be decentralized and super well designed. But I think that's the harder way to solve the problem. Just like, under the Bretton Woods system, it's not as though wages were being paid in gold. We had gold as a base money that was held in reserve. And there was a set of rules that determined, that we need to kind of collateralize our paper money with gold. And even on top of that, there was an electronic banking system, checking accounts and such, so that you didn't really need to kind of eventually even have paper money, right? And so there are all sorts of layers. And I think the most profound layer upon which blockchain can innovate is actually that base layer, right? The creation of monies themselves, right? Because like gold is naturally decentralized, but it's not very transactable, and you can't really control the scarcity of gold. It's not determined by an algorithm, whereas Bitcoin's scarcity is determined by an algorithm. Now, it so happens that they ended up just kind of doing something that would mimic gold in its steady state anyways. But that was a function of constraints, right? At the time of Bitcoin's launch, there were no exchanges. There was no notion of a price exchange rate at all. These were just units that were being mined. And now that the infrastructure has changed, we can take advantage of this information, which is the exchange rate of, this price signal, right? That tells you what the nominal exchange rate of this token is worth on a secondary market. Now that can be fed back into the money itself and be used to tell the money whether it should increase in quantity or decrease in quantity, which gets really exciting. But, for the everyday user, I think most likely your experience with these cryptocurrencies is more as though it's an investment asset. A lot of people buy it because like Bitcoin has been the best performing asset of the last year, and it's been the best performing asset of the last 10 years. And it's got this unique movement pattern, right? And then, increasingly over the course of the last year, people have started to embrace the narrative that it's a token that benefits from global instability, right? So when things like the coronavirus hit, or when, if there's, some sort of delay in trade negotiations with China, these kind of global instabilities benefit Bitcoin because it doesn't care about interest rates, and it doesn't care about the cost of human capital or, things like that. It lives outside this traditional market. And so I think the experience that most people are having with cryptocurrencies today is as a speculative asset that's uncorrelated with the traditional system. But I think that's actually kind of a good thing, because right now we're trapped in this macroeconomic cycle. I guess the economists would call it Triffin's dilemma, where the dollar as the global reserve currency is faced with this conflict of interest in supporting kind of our domestic needs with supporting international needs. And it's this kind of inescapable paradox. And so any asset that lives outside of that system is great, because it gives you the option to say like, well, I don't really like what's going on, or I feel I want to diversify a bit. I'm going to move some of my value outside of this traditional system, which is all being pushed around by the same macro forces, namely US-China relations, into an alternate ecosystem that's kind of disconnected from it. And that way I can kind of diversify, right? Because like when things hit the fan, as we saw like in the last financial crisis, like, the correlation of all these traditional assets kind of converges towards one, right? It's what they, kind of like a black swan event, right? So when something, substantially agitates the global economy, that affects everything in the same way within that system. And, Bitcoin is just disconnected from it. And so I think for most people, the day-to-day experience with these assets will be as like an investment asset. And eventually the user experience problem will most likely be solved by layers on top of these kind of primitives that could very well be centralized, and that's okay, right? So by the time it ends up as an app on your phone, maybe there's a centralized bank that taps into this decentralized ecosystem that sits on top of these decentralized base monies. But it's not unlike what we do with gold, right? It's not very easy for us to kind of send a nugget of gold from London to Tokyo, right? But we have a centralized banking system that allows us to do that. Now, the gold is still there. And if you believe those actors, that are kind of transmitting your value from A to B, you're okay. But if you don't, you can kind of just take custody of your own gold. And that kind of puts competitive pressure on those actors, to be honest, right? So that's mostly how I see things evolving.
This is very interesting. For some reason, I was thinking about a rumor I heard that underground in New York City, there's Chase Bank on one side of the street and the Federal Reserve on the other. And supposedly there was some tunnels that could take gold from one side of the street to the other if needed.
Wow.
I don't know if that's true at all, but I do know that in the past, before we really had a strong central banking system, JP Morgan had to come to the president and say, hey, these banks are going to fail unless we do something.
Yeah, he wrote a check.
Yeah, which is just crazy. It reminds me of what you were saying about President Nixon having to do that address around the time of Bonanza. So I mean, a lot of times it's just the huge financial systems hanging on by a thread, and most people are just completely oblivious. If everything keeps working, there's no problem. But like you said, there's a lot of actors behind the scenes making this all work. So it's interesting to hear you talk about finance and the decentralized nature, kind of the new age we're coming into, whereas it's not as dependent on some of these actors, human input, but they kind of still need to be there as like a guiding force. How do you see Ampleforth facilitating this new age of decentralized finance, if that makes any sense?
Yeah, totally. I mean, I see three potential outcomes. Like these are kind of just three maximal cases of crypto, and we fit into each of them slightly differently. So in the most basic case, it's like crypto is this uncorrelated, asset class, right? That's mostly speculative and creates optionality by diversification. Like I said, it's disconnected from the original system, but it's mostly used to store value and transfer value as a speculative asset, kind of the way gold is today. In that case, because amples are less correlated with Bitcoin and other digital assets, it would be valuable just for creating more optionality within cryptocurrencies. Because like right now, you can't really buy a basket of cryptocurrencies and diversify. So for the same reason you'd want to buy Bitcoin to diversify against your traditional assets, you'd want to buy amples if it grew to the right level of liquidity to diversify against, your digital gold, Bitcoin. So it's kind of like a digital gold or a digital silver, right? These things, you don't want it to move in complete lockstep. So it creates value just by being uncorrelated with both the traditional system and with cryptocurrencies. And there's another kind of maximal outcome where like the decentralized finance banking ecosystem does become really big, in which case, amples are really well fit as a base money or collateral asset for this decentralized ecosystem in that, well, number one, it's not a bank, it's a money, it's not collateralized, it's not centralized, and it moves differently from existing cryptocurrencies, but it also has this built-in countercyclical elasticity. So for the same reason it was designed to, theoretically work as a replacement for gold under Bretton Woods, it would be a very good primitive or base money for the decentralized finance ecosystem. And then there's like another case where it's like, okay, well, now imagine you're actually a central bank and you're thinking about holding things like Bitcoin in reserve or collateralizing your money with things like Bitcoin. Ample has a similar role to Bitcoin there, except for, again, in the case of Bitcoin, you wouldn't want to create a Bitcoin standard where like, every dollar was backed by Bitcoin. You would really, really kind of run the risk of deflationary spirals. So Ample would be better suited for something like that. And I think that's the least likely outcome. But there is this broad game being played. We are in kind of we're in a trade war, we're in a technology war, but we're also in a currency war where there are kind of halves. Well, there's one half, which is like the US. We have this global reserve currency. We're the dominant global reserve currency. And there are have-nots, which is everybody else. And because we have it, we can do all sorts of we can execute all sorts of expansionary policies, but we also have access to really easy credit, which creates this cycle of growing deficit spending. So we're constantly being incentivized to borrow more money because people want to use dollars. They want to take dollars outside of the US system. That puts pressure on us to like lend domestically, which kind of pressures other people who qualify for this easy credit to borrow and invest, which creates kind of these asset bubbles, which eventually results in kind of a recession, which causes us to borrow even more, right? So from everyone else, and everyone else just kind of has to do it. So there is this unknown end state of this cycle, but it does look like there is no easy way to stop the growing deficits and asset bubbles kind of increasing in amplitude. And I can see other kind of non-US entities desiring to kind of diversify. So rather than hoarding so many US dollars, if they're able to kind of start to hold in reserve different types of assets, that would make sense. So yeah, there's a path to that as well. But again, I think that's the least likely outcome, that central banks start to just use cryptocurrencies. A slightly greater likely outcome is like decentralized banks collateralized with decentralized currencies, and Amples would fit nicely there. And the most likely outcome, I guess the one that doesn't really require that much of a stretch of imagination, is that like these assets continue to be speculative, but disconnected from the traditional network, and Amples fit in that equation as well. It's just the flexibility of being uncorrelated and also having supply elasticity allows us to fit into a number of outcomes, including the one which I think is assumption minimal, which is it's speculative, it's disconnected from traditional assets. You should probably kind of diversify your Bitcoin holding, right? That would allow people to kind of deploy more into crypto if it were the case that not all of the assets moved up and down with such tight correlation. That would be good. So yeah, it's really just the diversifying kind of quality of it, but also its supply elasticity that allows it to fit into so many outcomes.
Yeah, that is super well said. Again, as usual, I imagine this would kind of change how traditional crypto traders interact with Ample, say, since the elastic nature that's kind of similar to fiat. I don't know if that's a fair comparison, but how is this going to change the kind of reward basis for people who used to try to get the maximum profit?
Yeah, totally. Yeah, I mean, so right now, I mean, the price kind of series of Ample will always kind of hover around 1. So it might be greater than 1 for some time and then return to 1, or less than 1 for some time and then return to 1. But it'll kind of just always hover around this number 1. But if it's greater than 1 for any kind of extended period of time, it's outside the equilibrium band and you're accumulating more in quantity, because the goal there is like we want to give everybody more Ample so that the price will eventually sell back down to 1. And so you're gaining not only based on the price appreciation of Ample, but the quantity appreciation of Ample. And that puts kind of people in this race to sell. Eventually it's kind of like, okay, I don't want to sell down yet because I think I'm going to continue getting more Ample for like another 7 days or something. Like, for example, the last 7 days, Amples have been outside the equilibrium band and positive. So people have just been getting more Amples. There eventually will come a time that says, okay, I think I'm now going to start to sell a little bit of it. Maybe like long-term holders can always just hold and forget it, kind of just like Bitcoin is non-dilutive. But if you're more of like a near-term kind of fast trader, you'll realize there's an opportunity now where like not only do I have more Amples, not only are Amples greater than $1, like say they're $1.20, not only are they like higher than the natural price of Amples, but I now have more Amples than I previously did. So I'm going to like sell some down. And that's what creates that downward pressure that ultimately restores it to its equilibrium price, where everybody kind of just has more Amples, but now they're valued at 1 per unit. And the opposite kind of happens when it's contracting. So it falls under 1 and we're decreasing the supply. You get engaged in, eventually you're in a race to sell when it's over 1 and you're in a race to buy when it's under 1 until it just gets there. And that's when it's found its equilibrium spot. That's when supply and demand are in equilibrium. And because the appreciation of your value is a function of both price and quantity, then traders will just have to look at price times quantity, which is actually just, market cap, right? So they'll be looking at market cap increases and decreases as a proxy for gains and losses, rather than just price increases or decreases as a proxy for gains and losses. And this is really fundamentally different because all technical analysis today, one of the simplest things to look at is the moving average price of the coin, right? So we always talk about the 200-day moving average of Bitcoin, or the 7-day moving average. Is it up? Is it down? Was there a bull cross, right? Is there kind of a death cross? They have all this kind of terminology for geometrically analyzing these waveforms. In the case of, Ample, over a long timeline, the moving average is always just going to look like flat because it leaves the equilibrium up and then, returns, or goes down and then returns. But, looking at that moving average would not paint the full picture. You might very well have 10x to your value because you gained 10 times the quantity that you once had, right? And so really they have to look at a different chart, which is the market cap chart. And that pressures a different kind of trading behavior, which is what gives rise to this step function like movement pattern, where it kind of just snaps to equilibria, goes, and if there's a meaningful increase in demand, it'll leave equilibria and snap to it again, or if there's a meaningful decline in demand, it'll leave equilibria and snap to it again. So yeah, it's really weird. There's no asset like it. That's kind of what we found interesting about it, and also what our academic advisors found really interesting about it, because it's just not something that could have been done without a blockchain. It takes advantage of all of the properties of the blockchain. It has kind of a functional position in the economy at steady state, and it has this kind of utility in the near term as a collateral asset for decentralized banks, which are kind of quickly gaining traction.
Very, very good. Earlier you mentioned it was, forgive me if I'm misspeaking here, but tied to the 2019 dollar. Is it dependent on the US dollar?
Yeah, not quite. So the price target is the CPI adjusted 2019 dollar. So we receive, an automated feed that represents the CPI adjusted dollar of 2019 from the BCE, right? Which is, it's basically a CPI metric. But for example, when we launched, right, the price target was $1.00. That was the end of last June or so. And now the price target has changed. You can see to 1.01, right? So just because of inflation, right? Now the price target, which was once $1, is now $1.011, which is actually what the purchasing power of the 2019 dollar was when we originally launched. So over time, you'll see that this price target kind of just generally increases, right, as denominated in present day dollars because of inflation. So today it's 1.011, but at 2% inflation per year, that will increase it. One day, the unit price of an Ample might be $2. In that way, it actually is interesting because it could be used as a unit of account more accurately than even US dollars today. We know that a long time ago, maybe a can of Coke cost 25 cents, but now it costs $1. Let's just say that's true. I don't even know if it's true, but it probably is true. If it were denominated in Amples, its price would always be its price because the target is actually stable in terms of its unit purchasing power, not just its relative exchange rate to other currencies like the US dollar is. So that's really interesting because so much of what makes monetary economics and monetary policy what it is kind of today is this notion of price, which is again a function of people denominating in these assets. So yeah, that's another kind of interesting property of Amples. So no, it's not quite connected to the US dollar. One Ample is meant to represent the purchasing power of a 2019 dollar. So it's almost like that's frozen in time.
Okay, yeah, that makes sense. Thank you for explaining that. I like a lot of what you're saying, and unfortunately, we're running out of time here. We might have to do a part 2 sometime soon because this is...
Yeah, that'd be fun, man.
it aligns perfectly with the goal of the podcast, and I love the history of money and the insights into economics. But I just wanted to give you an opportunity for any closing thoughts, where people can go to get involved and connect, to learn more and that sort of thing.
Totally. If you want to learn more, you can visit ampleforth.org. So ampleforth.org. And the token is live and trading. It's available for purchase on Bitfinex, on Uniswap, on Kyber, on KuCoin. And if you're interested in reaching out or communicating with us, feel free to send me an email, which is just evan@ampleforth.org. And really, thanks so much, Ethan.
Yeah, my pleasure. This has been a really good talk, and I look forward to reconnecting in the future. And I just wish you all the best for the time being.
Cool. All right. Thanks, man.
Thank you. Thank you for listening to this episode of The Blockchain Show. My guest today was Evan Kuo, the co-founder of Ampleforth, a decentralized commodity money like Bitcoin, but with near perfect supply elasticity like fiat. You can connect with us on Facebook, Twitter, Minds.com. It's probably where I'm the most active, at KinderConnect or The Blockchain Show. You can send an email to us, info@theblockchainshow.com. I hope we can have Evan back on for a part 2, talk a little bit more about cryptocurrencies and the financial landscape, where decentralized finance is going. If you'd like to hear more episodes like this, definitely let me know. I enjoy the feedback we've been getting lately. So if you'd be kind enough to share this with someone who you think might enjoy it, that goes a long way in helping spread the message. Another thing you can do is give us a kind rating or review even on Apple Podcasts, Stitcher, wherever you get this podcast. If they have that feature, it helps other people get awareness to the show. So we've been doing this since 2016, and it's been a really fun ride so far. Definitely learning a lot and continuing to learn and grow as the space evolves. I still have a lot of hope and enthusiasm for this to be a positive force of change in the world. It takes everyday people like you getting involved. Just listening to this episode is beneficial. So thank you to Evan, and thank you to Caitlin for helping us set up this interview. I hope to have more episodes like this in the near future. Until then, we'll see you next week.